started back in 2009.
Uh-huh.
Back then I was working the engineering job that I didn't like.
Right.
And that's kind of what I talk about in my new book, The Wealth Elevator, is just, it starts off slow, but
Yep.
it's the grind to just saving up your money. You may work a day job, you may be an entrepreneur, but it's just like this, it's not a get rich quick scheme, this financial path to financial freedom.
Welcome to the Audacious Living Podcast, hosted by my man, Audley Stevenson, the Odd Man.
Greetings and salutations. Welcome to the Audacious Living Podcast, where our goal is to inspire and empower our listeners to live their best audacious life ever. If you've been here before, I say welcome back. If it's the first time, thank you for joining us on this journey of growth and transformation. Just like building wealth through real estate, achieving success in life requires taking small steps with patience and persistence. Scaling up your wealth is like constructing a building. Each small step lays the foundation for something greater. Now, in today's episode, we delve into the world of real estate investing with Lane Kawaoka, who shares his insights on starting small and thinking big. Lane is a successful real estate investor and entrepreneur who has built a portfolio of rental properties worth billions of dollars. With years of experience in the industry, Lane is passionate about sharing his knowledge and helping others achieve financial freedom through the world of real estate investing. Lane's expertise in real estate investing and wealth building make him a valuable guest for this particular episode, where he shares his journey, insights, and lessons learned in the world of rental properties. So without any further ado, here's our conversation with Lane. Enjoy. Hey, Lane, thank you for joining me here on the Audacious Living Podcast. It's great to have you. Thank you for taking the time to do this. Thank you, my friend. Appreciate it.
Yeah. We kind of have to move things around, but hey, that's
Life,
what living
man.
life audaciously is, right?
Well, and you'd understand a little bit about that. Being in the investment space, it's all about taking risks and chances, and maybe have a little bit of courage as well. As a starting point, can you kind of fill our listeners in sort of the work that you're into? I know you got your book and there's a bunch of things that you're into, but let's fill our audience a little bit about who you are and what you do.
Yeah, so today we own 10,000 rental properties, about $2.1 billion assets under ownership, mostly apartments in the southwest. But I think, what I want to kind of focus on today is aside from like vanity metrics today, I started back in 2009. Back then I was working the engineering job that I didn't like.
Right.
And that's kind of what I talk about in my new book, The Wealth Elevator, is just, it starts off slow, but it's the grind to just saving up your money. You may work a day job, you may be an entrepreneur, but it's just like this, it's not a get rich quick scheme, this financial path to financial freedom.
And that slow start is something people struggle with, Lane. I got to tell you, I mean, you especially when you get going, and what doesn't help, right? You go in the world of whether it be social media or you see other people are doing, and they're all showing off, what they have, but you're not seeing that slow grind that you referenced to get to where they're at.
Yeah, I mean, I have a talk on my website where I'm huge on like people not quitting their day job for a variety of reasons.
Right.
But I mean, we had maybe $1 billion of assets under ownership in 2020, and that was maybe about a year after I quit my day job.
Gotcha.
So I mean, a couple of reasons right off the top of my head. You're leaner with your time, right? When you have a day job, you've got to kind of do that a little bit so you don't get fired, and you get really efficient with your processes, and the money from your day job should help supplement the starting part of your business, which in the beginning of anybody's entrepreneur career, it's your capital, it's in capital intensive business, and that's what you need in the beginning.
Yeah. And then, I mean, the other part about quitting your day job is you're not worried about living still. I mean, that's a big part of this, right?
Yeah, exactly. And then that transforms into like, you're, being an entrepreneur, you're making little micro deals all the time. Every meeting is a negotiation, as we all see, right? We always you don't want to be in a position where you have to make a bad deal out of necessity for yourself, right? So if you're desperate because you don't have money coming in from your paycheck, you're going to put yourself into a lot of bad partnerships and, long-term deals that you're going to have to carry on through.
Got you. So you talked off the top about where you're at now. Can you give me a sense or just general idea of where it started for you?
Yeah, so 2009, started to work as an engineer, as a construction supervisor. And I call this the linear path, right? I was taught to go to school, study hard. I got an engineering degree, started working, and then also, invest in the 401k, which I don't believe in, and buy a house to live in, which I did, right? I saved up 60, 70 grand to buy a house in Seattle, Washington. But up until that point, that's the linear path, right? That's what we're all taught to do. My parents taught me to do blindly. And then at that point, I, just by chance, I was working on the road all the time and, living out a suitcase. And I was like, well, I'm a young 20-year-old and I got this big house to myself. Why don't I just rent out this house? I'm only here on Saturday. It felt like.
Right.
And that was where I got the taste of this cash flow, right? Where the tenant paid down my mortgage for me and I had several $100s of beer money back then. This is in my early 20s.
Right.
And then, that went on for a while. And I was like, wait a minute, if I just did this again and again and again, rinse, wash, repeat, maybe bought better properties that were better rentals. Later I learned about the 1% rent to value ratio, where you take a look at the monthly rental price divided by the purchase price, and you're looking for something that's 1% or higher. So that's a quick and dirty way of running a property. And then, buying in, maybe not the best areas, but not the worst areas too. So starting to learning about buying properties in B class areas and B class properties, finding that sweet spot as a rental property owner. And then fast forward to 2015, I had bought 11 rental properties at that point. And I started to get around accredited investors, people with $1 million net worth or greater. And they were all kind of getting out of their rental properties. I'm like, what? I thought rental properties was the way to financial freedom, right? That's what everybody thought. But then I started to realize these accredited investors, they started to trade up in a way, like the Monopoly game when you're trading up greenhouses for red hotels, I guess. Not directly, right? But start to go into these syndications and
scaling up is what you're referring to. Scaling up to that next level.
Exactly. There's a pivot point in there. And this is kind of what the whole premise of my book, The Wealth Elevator. There's different floors to the wealth elevator.
Okay.
There's the basement where you don't have any money. You're broke. You don't even make 50 grand per year.
Right.
I was lucky enough, I went to college and I was super fortunate and have a lot of gratitude that I didn't have to start in the basement. I had a lot of good financial skills already. I wasn't in credit card debt. I had some student loans, but I was starting in the first floor of the wealth elevator. And little did I know, what I was doing was exactly what the prescription was for that floor, which is buy little rental properties until you get to accredited investor status. Then you switch to the second floor of the wealth elevator, which in our book, I have all these, charts and graphs because I'm an engineer and I think, visually like that.
Right.
But, the strategy's pivoted, right? Do you even use self-directed IRAs or Roth IRAs at that point? What are you doing for your privatized banking? What do you do for your taxes, right? What I discovered is as you move through these paradigms or these floors, the strategy changes.
Yes.
And there wasn't any book out there written for higher net worth investors, people who, I like Dave Ramsey. I like the guy. I've actually met the guy.
Okay.
But a lot of those financial advice is made for people who are in the basement level of the wealth elevator, right? There wasn't anything for people. I think like Kiyosaki, Rich Dad, Poor Dad. I think a lot of that is written for the people in the basement level or just starting out, but there wasn't anything for like the second floor or the third floor penthouse level of the wealth elevator. And that was kind of the curriculum I wanted to create out there.
I got to give you a lot of credit, Lane. I mean, for a lot of people, being an engineer, you can make a pretty good living and do quite well for yourself. Could you not? But you just wanted more, which I think is fantastic because there's always another level in line with your wealth elevator analogy.
Yeah, well, I mean, that's the funny thing, right? Like a lot of investors in this real estate world are engineers. In reality, engineers, you're never going to go broke being an engineer, but you're never gonna, be able to drive the nice Mercedes. Like most engineers, they cap out at about 150,000 a year. Definitely not the salaries of dentists, doctors, lawyers, or successful entrepreneurs. That's for sure. So I think part of the reason, I mean, other than the fact that engineers aren't really scared off by the numbers, but I mean, the numbers aren't that hard, right? Like in real estate investing. I mean, people want to download my free analyzer on my website. They can go to the wealthelevator.com/analyzer and get the free spreadsheet there. It's not that difficult. Right. But I guess maybe engineers aren't scared off by that stuff initially. But I think the biggest thing is like engineers have just enough money to do something with it, to start a seed. And there's that need there, right? Like you don't know how many like doctors that make $500,000 a year that have horrible personal finance skills and
right.
I mean, doctors are notorious for being some of the worst investors out there, right? Because they think they're very smart and they don't consult the different viewpoints of other people, etc. But they also don't have the need to, right? They make such a phenomenal salary. They don't really need to save. So there's always this element of need, right? That creates a situation.
Right. No, that's a really good point. Out of curiosity, I mean, I guess it depends when you think of an elevator, the analogy of the elevator in a building, how high can you go? Like, is it sky's the limit kind of thing, or where's the limit? Is there one?
Yeah, I mean, so what I would put as a data point out there for people is like, once you hit $4 to $5 million net worth, you've kind of hit this sort of plateau where most people in my investor group are happy, right? Because at that point you're able at a dividend rate of 4 to 10%, in that range. You might be a little bit more conservative and want to take your chips off the table with T-bills, or you may want to still play with some private equities that are a little bit more conservative, or alternative investments is what we kind of teach people how to invest in with real estate and syndications.
Gotcha.
But at that point, you're able to produce $15,000 to $25,000 of passive income every month. Enough for most people, especially once your kids go off to college and they're not, financial liabilities at that point.
Right.
But, for most people, like our goal is to get people in their 40s to $4 million net worth. Obviously, that will increase in their 50s. That may be, to a point where they get in their 60s, they're already getting to the 8 figures, 10 million plus.
Right.
At that point, that's a good wine budget, right? I mean, each their own, right? It's once you start to get moving on that escalator, you start to acquire some nice tastes, and just at that point, definitely the whole more money doesn't incrementally make you more happier at that point for sure.
Right.
But most people aspire to get to that $4 to $5 million net worth. Anything more, I think, is a little bit overkill.
Right.
But hey, like what we're trying to do here is like we try and teach the next generation these financial skills, because most times family lose their net worth in whether that's just $1 million, it gets blown in 2 to 3 generations. Anyway, because they don't have these financial skills. They don't listen to podcasts like yours. They're not in growth mode. They're in kind of,
in the moment mode.
Yeah. Or, just blow what mom and dad did. Right. Or grandma and grandpa in most cases.
Well, that's and because they didn't put in that time, that effort, the work to get there, the level of appreciation is just different, right? They've got more of an entitlement sort of mindset versus I really worked hard to get this, and that's a big difference.
Yeah, I mean, one would say that they're spoiled, but on the other hand, it's like, I mean, a lot of my clients who they pay for things for their kids, right? They want to make an easy life, but if you don't grow up, going back to that, we're talking about engineers, how they have a need to, be good with their money. For the younger generation of first generation millionaires, which is what most of our community is, there's no need to, right? Like you have a good life. So, I look at it from always both sides, right? I mean, I'm in this kind of early millennial, late Gen Z population, and I see it from both ends. I see it both ways. It is what it is. I think a big element of it and why we've created the Wealth Elevator community is like you need people around you, right? You are the 5 people that you are average you hang out with most. So if you can get your kids and grandchildren in a community with people who are thinking the right way, conscious about their money, and know these fundamentals, and fitting them in a group of 5 people that they enjoy and they want to grow together, then I think that's the way that we've kind of round up, this system.
Got you. Lane, when did you get to the point where you wanted to now give back to others? Like, I mean, I understand you came in, you're thinking about what, how you can build and grow, but then you got, now you're at the point where as you said, you're building a community. When did that happen? Or was that part of the original plan for you?
Well, I mean, it's 2016 was when I started my podcast, and we started to build this community back then.
Okay.
But it probably started like several years before that. I would talk to my friends about buying little rental properties, and just like I'm sure a lot of people talk to their friends about, personal development and, entrepreneurship out there. But as you guys all know, you talk to your friends and they're good guys, right? Good guys and gals, but none of them freaking listen. Right? Like, it goes on deaf ears.
Like,
I hear you guys. It's lonely out there, right?
Yeah.
That's and that was kind of where, again, I started the podcast in 2016 as sort of a need and thirst to, I want to get my, it changed my life. It's changed my life drastically, right? And I think it does good things to people. There's a lot of misinformation out there, right? Yes. And I think that for me, it was just like, it made me happy, right? Because initially 2016 to 2018, when the podcast was getting going, I would get like emails back saying like, kind of like fan mail, right? It made me feel great, right? Pump the ego up for sure. And then, obviously 2016 was a long time ago, and I've kind of formulated as I kind of made this journey, right? At that time, we were just kind of teaching people how to buy little rental properties, which I always thought was the thing. And then I realized, wow, there's a mountain upon the next mountain. And then, as we mentioned, like, there's something beyond the $10 million, beyond the $50 million net worth threshold.
Yeah. It's almost like you were learning as you were growing, right? Like, and so you're learning, you're growing, and helping others, all kind of all in the same time, it sounds like.
Yeah, exactly. I mean, I don't claim to know it all, right? And as I always say in the disclaimer in my podcast, I reserve the right to change my mind as I find the next best thing. But I think that was why the podcast got so much traction in the beginning, because it was a follow my journey along. I didn't speak so authoritatively, I guess, as I did today. I was kind of trying to figure it out myself with all my crappy rental properties back then. Sure. But, I think what confirmed it was like meeting so many other accredited investors out there. And if you're not an accredited investor, then, you just don't get access to other accredited investors. Understood. And you don't get you don't get that vision point. But
so, Lane, I think a big part of we talk about sort of teaching people lessons and helping them on their journeys is also sharing some of our mistakes and our lessons learned on our own pathway. And I mean, that's how you learn, right? And so I'm wondering if you could perhaps enlighten our audience on maybe a lesson or two that you learned on this journey as you're in this rental space industry and figuring out what makes the most sense for you.
Yeah, I mean, I would say, like, there are a lot of like kind of guru courses out there that say, well, you can just go buy an apartment. I really don't believe that. You need to have a, decent net worth, $1 million or greater, to start taking down larger assets. Yeah. And that's my whole thing is like, well, you got to start somewhere. You got to start slow. So it started with the first rental back in 2009 for me. Yeah. And then I bought my next one in 2012. So it took me like 2-3 years to save up for the second one. And then they started to go a lot faster. And then that's this concept of like the flywheel, right? It's in the beginning, it's slow, but then it speeds up. And then, it got to 11 rentals in 2015 and then kind of off to the races. But like, I think when you distill it down to it, it comes down to you need to, have real estate, especially as a capital intensive business. Right. I don't teach people how to wholesale houses or do all these no money down stuff. We're not that type of investor group. We ultimately, what it distills down to is saving up the 20% down payment. Right. So on $100,000 house, that's 20 grand you need. That's right. Bare minimum. And what it comes down to is like personal finances. And I have a lot of free coaching calls that we record on my YouTube channel where, if you're kind of starting out in that basement level, first floor of the wealth elevator, go and review those under $1 million net worth coaching calls, where the name of the game is just saving money. And most of my clients today who are credit investors, they save $40,000, $70,000 a year, which might seem like a lot. But if you're able to save 10 grand a year, you're off and rolling, right? Like, 2-3 years, you can buy a rental property. And then when you put assets under your belt, you're able to expand your income and you can probably save more.
Right. It's a very patient game, isn't it?
This, like I said, this is not a get rich quick scheme. No games, tricks are for kids.
Yeah.
No tricks here.
Yeah, no, for sure. And I think the idea of really having a solid and firm plan. And so you just talked about, saving, and maybe it's over a couple of years or a few years that you're making sure you've got enough for that 20% down. And really all 20 is the bare minimum. You probably would you advise a bit more?
Yeah, I mean, you're buying a rental property, things are going to break, things are, tenant may skip town, so I would at least have an extra 5-10 grand on top of that down payment. So like maybe at least bare minimum 30 grand.
Got you. Is that something that you learned? Is that sort of a lesson, I guess, or that you came across? You're like, oh wow, I wish I had done, or maybe I should have done it this way instead.
Maybe not lesson learned, but like, I mean, like that was always like prudent financial literacy in my opinion, but I guess not, right? Since most people don't have real basic financial skills, right? Oh shoot, I better have a little bit of buffer here, contingency, because things will go wrong. But a lot of these rental properties, tenants don't pay 100% of the time. When I was first starting out, I had 5 houses in Birmingham, for example. They weren't horrible houses. They were more on the class C plus, class B side in the middle. But every month, one of the tenants were always late to pay if they paid, right? So for some people that live in high priced areas or, with more affluent, peer groups, that may seem ridiculous, but most of people in America, they get money orders from Walmart. I didn't know they sold money orders at Walmart. That's how a lot of people in America live. And those are the tenant base. But that's why we invest in that sector, right? The lower middle class sector, because in this country where the population is increasing, there's a bifurcation of the wealthy and those who don't. Obviously what I'm trying to do is, for those you guys are listening in the shrinking middle class, we're saying, well, get on board with these investment strategies to get access to the tax strategies so you pull yourself off, because if not, you're going to get brought down into the lower middle class.
Right. And there's some inherent risks. I wonder if we sort of talk about risks in general, because we can talk about being audacious all we want, but until you're prepared to take some of these risks, you're not going to get it where you need to be. I wonder if you can talk about some when we talk about risks, some ones that come to mind for people. Anything you identify?
Yeah, I mean, a lot of it just comes down to money, right? I mean, money pays for repairs, damages, tenants skipping town. I mean, I've had, like on my YouTube channel, I've had like a walkthrough of my property once a tenant just trashes the place. And you're not going to be able to collect the damages from people like that. I would say I probably had maybe almost a dozen evictions out of my single family home rental property. 1 out of 3 times it'll result in like a big $10,000-$20,000 repair bill.
Right.
So you've got to have that to absorb, right, on the side. But that's kind of the risks of this, right? I mean, that's why you need to get more rental properties, right? I mean, it can't tell you how like demoralizing it was to like when that happens, you're like, shoot, that was like the profit for like 3 of these freaking things for a couple of years. But that's why you have to expand the portfolio. But as you start to get more and more rentals and you get more steady state, the law of averages, kind of smooths out, and you see why it makes sense in the long term.
Got you. Now
but you are exposed in the beginning, like you said, right?
Oh yeah, well, and you know what? There's a part of it too. So you think, well, you spend 2 or 3 years, you save your down payment, you do all the work to get yourself to a place where you can rent a place, and then someone trashes it, or someone a tenant skips. Like, it could be so debilitating and so upsetting because you recognize all the hard work you did to get yourself there, and that's got to be tough for a lot of people.
Yeah. Hey, I mean, it is tough. That said, there's risk in everything. And you need, especially in the beginning, you're going to need to take the most risks in the beginning.
Yeah.
And you can mitigate that by, obviously everybody should have property insurance, umbrella insurance. You mitigate that with having an extra 10, 20 grand in reserves in your bank account. Don't go buy that Corvette yet. Don't do anything bonehead like that yet.
Right.
I mean, if you can, I guess you could sell it for like a fraction of the price, but that's just things happen in life, and you just gotta absorb it, try and mitigate as much as possible within practical reasons, and keep moving on. And like I said, it just gets easier after a while. That's why I always, whenever I write something or I post something, I always try and keep in mind that like the hardest part was that beginning investor and getting them over that hump of that first rental property.
Right. And then I guess as time goes, it sort of falls into place easier. Not easier, but certainly flows better once you kind of get over that initial hump.
Right. And you got more money to absorb things.
Right. There you go. So first of all, Lane, thank you for this. And the insights have been fabulous. I think for people who in the back of their minds are kind of thinking about it, and then hearing sort of some of how you laid it out, and it totally does make sense. The wealth elevator, there's 5 levels, right? In your book that you identify for people. And then of course there's the podcast. For individuals that wanted to sort of connect with you directly, where can we send them?
Yeah, if they're accredited investors, they can sign up at thewealthelevator.com/club.
Yep.
If you're not quite there yet and you're looking to buy little rental properties, I would probably suggest our info page, thewealthelevator.com/turnkey. Great way to get started in rental properties. But if not, check out the book, right? I think that's important to kind of know the big lay of the land first before you start charging ahead, even if you are in the basement level.
Yep.
Because
there's nothing wrong with being in the basement too. I mean, it's important to understand that that's a starting point, right? And we all got to start somewhere. So the basement's where we start, but you've got the lay of the land in front of you. That's not a bad thing.
Yeah, like I mean, if I would have done it all over again, I wouldn't have bought 11 rental properties. Okay. I would have gotten a few and skipped to the bigger deals.
Got you.
But that's all in hindsight, right?
That's right.
I mean, that's I think why I say, well, read the book, where the levels are, and hopefully that can help expedite you and maybe cut some corners along the way.
For sure. Well, Lane, this is awesome. We're going to make sure that, all the contact details, appropriate information is in the show notes for our listeners. Appreciate you taking the time and doing this, and all the best.
Yeah. Thanks for being flexible with this. Appreciate it.
Yeah. Not a problem, sir. Take care.
All right. See ya.
Back we are here on the podcast. In today's chat with Lane, we learned the importance of starting small, staying patient, and taking calculated risks when it comes to building wealth through real estate. Lane emphasized the value of persistence, financial literacy, and the power of savings in achieving long-term success. If you want to learn more from Lane and take the first step towards building your wealth through real estate, check out the show notes for contact details and connect with him directly for personalized guidance and advice. You can also explore Lane's website for exclusive resources, coaching sessions, tools to accelerate your wealth investing journey, as well as his book too. So he's got that out there you can take advantage of. He's got special offers and products that will help you reach your financial goals faster without question. Thank you for tuning into the Audacious Living Podcast. As always, if you've enjoyed this episode, please like, follow, subscribe, or share with friends to help this platform grow. Stay audacious, keep dreaming big, and never stop pursuing your goals. Until next time, stay safe, be kind, show love to one another, and be audacious.
You've been listening to the Audacious Living Podcast, hosted by Audley Stevenson. If you enjoyed what you heard, be sure to like, subscribe, and share. Until next time, be audacious.